everyone, welcome to our presentation of business sustainability. This presentation will go over the definition of sustainability, explain why time is an important consideration for firms' decision-making, the step to sustainability and strategy, explain why sustainability is not a responsibility, and finally, some research findings and mainstream beliefs. Before discussing the definition, I would like to share an example from the paper. On November 26, 2010, Unilever announced that in the future, it will release its earnings figures semi-annually instead of quarterly. The company's share price fell with this announcement, but 2 years later, the share price was 35% higher than its pre-announcement level. Moreover, Unilever reduced the percentage ownership of short-term hedge fund from 50% to 5% and attracted more patient capital. Why this happened? Paul Polman, the CEO of Unilever, believes that the short-termism lies at the heart of many today's problems. He sees that short-termism as the bane of sustainability. He wants the latitude to make investments that do not necessarily deliver short-term return, but realize long-term benefits. Polman believes that sustainability is not an act of kindness, but a strategy for creating long-term business value. Now, let's talk about what is sustainability. Sustainability is commonly defined as development that meets the need of present without compromising the ability of future generations to meet their own needs. It aims to secure intergenerational equity. As we all know that most of the people want to live as good as their parents and want their children to enjoy similar opportunity. Same as the firm, most managers want their business to be at least as profitable as in the past, and ideally for profit to grow. Business sustainability can be defined as the ability of firms to respond to their short-term financial needs without compromising their or others' ability to meet their future needs. Therefore, time is central to sustainability. For firm to service, managers must administer their investment to secure both short-term profit and long-term income stream. Sustainability requires trade-off, especially across time. Firms choose between investing less for smaller profits sooner or investing more for greater profit later. This same principle applies to the trade-off between exploitation and aspiration. Firms profit from exploitation by marketing and selling current products and services, but it also must invest in exploration activities, such as research and development, to secure a future pipeline of products and services. Next, as I mentioned in the beginning of the presentation, the CEO of Unilever awares the problem with short-termism, which is also the main threat to sustainability and strategy. In a landmark study of 400 executives, primarily chief financial officers, the study found that nearly 4 out of every 5 executives willing to sacrifice long-term value creation in order to smooth earnings or meet short-term earning targets. Short-termism can be defined as decisions and outcomes that pursue a course of action that's best for short-term but suboptimal over the long run. Humans have a bias for immediate gratification and temporal discounting. We generally prefer to consume less now than wait for more later. Urgency and uncertainty exacerbate the bias because people want more rewards now and future rewards are obscured. There are a few reasons why short-termism can lead to suboptimal outcomes for both firms and society. First, investment driven by short-term payoff tend to be incremental rather than transformational. Incremental firms focus on operational efficiency or adjacent moves into new product markets. They are unlikely to invest technology that will help them leapfrog their competitors. On the other hand, the transformational firms are able to manage between short-term and long-term. They are more likely to invest in research and development for new product and process innovation, train their employees for higher productivity and lower turnover, and build enduring relationships with the community. These firms understand how to manage their limited resources. Second, firms that rely too heavily on short-term investments experience more volatile earnings. As managers become increasingly myopic, the return on their investment either become more marginal or managers taking significant risks to potentially secure windfall gains. In neither case, these firms often fail to build long-term value, as a win is often followed by a lose. To sum up, short-termism is the arena in which strategy comes up against sustainability. Current series of strategy management are contributing to short-term decision-making. Not only is short-termism potential hazardous to organizations, but it can also contribute to system failure, which ultimately leads to firm failure. To avoid market failure, strategy must integrate sustainability in its theorizing.
Let's continue with the part of sustainability is not a responsibility. As we mentioned before, sustainability requires intertemporal trade-off. So sustainable firms need to choose to invest less for small profit in a short period or invest more for a larger profit in a longer period. However, corporate social responsibility does not necessarily need to trade off. It represents the set of organizational activities that are good for society and the firm simultaneously. According to shared value and win-win ideas, responsible firms can achieve the goal to create value to business and society together. So we can see that sustainability is different with responsibility. Even when we talk about triple bottom line, which is social equity, environmental and financial factor, which is how sustainability is conceptualized at the first time. Its definition makes sustainability more like a responsibility because it does not notice that sustainability's characteristic, which is cross-time trade-off. Then I want to use different paradigm to explain sustainability is not a responsibility. Ethics, morality, and norm permeate corporate social responsibility. These moral imperatives stem from individuals inside the organization or from external stakeholders, and firms must choose a behavior that is most adapted to this value. Therefore, the challenge of responsibility is to balance the competing demands of different stakeholders. However, there is no moral imperative regulate firms should do work for sustainability, and sustainability focuses on the balance between macro-system and organizational, so they would not judge one behavior is right or wrong. For example, sustainability scholars can comment on excess greenhouse gas emission creating change in climate system, but they do not have the tool to judge whether the new climate regime are relatively good or bad. Also, sustainability and responsibility will produce different outcomes. Corporate social responsibility creates shared value by addressing competing stakeholders' interests, and their focus on current competing stakeholders' interests will obscure intertemporal trade-off. And most troubling is that corporate social responsibility pursue a higher speed and unstable growth in the share value. And this situation returns to borrow resources from the future. And it will intensify the imbalance of resource distribution between now and the future. System failure may happen in this situation. Compared to corporate social responsibility, Sustainability focuses more on the balance of resource use between current and the future, and it would not allow the situation of overuse the resource to build the current economy. However, it's understandable to confuse between corporate social responsibility and business sustainability, because society's timescale are longer than business timescale. Corporate social behavior creates value for both business and society in the short run, but do not necessarily sustain the viability of micro and macro systems in the long run. There are some activities that are either responsible or sustainable, but not both. For instance, charitable donations that rely social problems are responsible, but they are not sustainable if they do not resolve the underlying issue. Also, there are some sustainable actions are neither responsible nor irresponsible. Those practices are often flexible, and the firm can adapt to the environment change quickly. For example, 3D printing produces what is needed and requires less resources. It shows that they can quickly adapt to new technology, and design and sustainability can more readily and more flexible adapt to new macro demand to manage the intertemporal trade-off.
I will introduce about the research agenda as the intersection of sustainability and strategy. Sustainable competitive advantage has been the primary concern of strategic management theories. Most strategy theorists argue that firms can achieve a competitive advantage that endures over time, and this can enable them to generate above normal profits. From a sustainability perspective, the competitive advantage may not be sustained over a long period of time. The above normal profits cannot be predicted easily because systems tend to cycle through different periods. According to the situation, it offers two suggestions for integrating business sustainability more fully into business strategy research. The first one is a dynamic systems view of strategy, and the second one is film performance that captures long-term value. There is a limited number of strategy research that mentions time at either the individual level or the film level, and even fewer that integrates time into these two levels of analysis concurrently. Most strategic management theories aim to describe organizational decisions and actions by analyzing film-level outcomes, but they ignore the larger system in which the film is embedded. The tendency to focus on a single level of analysis obscures dynamic system over time, especially in understanding the sustainability of the film and the system, and finally offer insights into the success of organizational strategies. Organizational scholars often focus on a single level of analysis so that researchers can better identify the relationships which will help inform managers about good strategy. However, this also provides an incomplete picture of organizations. Compared with this, dynamic system theories shift the lens to the bigger picture. The film's outcomes are seen as part of a larger system of outcomes, and issues of sustainability and organizational viability over time become important. Although dynamic system models may not allow managers to as easily predict and control as current strategic management theories, they rarely place in sharper focus issues that will ultimately affect organizational outcomes. Strategy researchers often use financial performance to measure the outcomes of business strategy. Each measure collects data that are recorded over time into a single number, which removes the temporal dimension. In fact, market measures that look far into the future use discount rates so that future earnings are valued less than present earnings, whereas sustainability scholars aim to give equal or more value to the future. At the heart of most strategic performance measures are assumptions that might be at odds with sustainability. even if marketing measures accurately represent future cash flows. There is no way of accessing the temporality of that flow. Because money is fungible across time, many strategic performance measures lose the informational value that time holds. Sustainability research calls for a wide measure of film performance that accommodates time-biased information, one that can convey not only the film's profitability at a point in time, but also its sustainability over time. Even though sustainability has fast become the fashion, short-termism is increasingly the practice. It is not sustainable, nor is it a good strategy. There is little debate that strategic management and organizational theories can benefit by accommodating time more fully in decision making. In so doing, strategy will integrate sustainability. The impact of this integration could be profound. The bitter contest between business and society will abate when time is incorporated in strategy and organizations. An impact on society comes into sharper focus when the long-term impacts of strategic decisions are considered, because long-term investments tend to align business with society. Sustainability, therefore, can contribute to responsibility, which is a part of a good strategy. Sustainability is suffering a new paradigm that acknowledges the complexity of systems and the inequalities or imbalances that can undermine their sustainability. It challenges decision makers not just to manage resources at a point in time, but manage resources across time. By incorporating time, it also recognizes that future is not always knowable and controllable, but that such uncertainty is acceptable when systems are resilient. About the conclusion of the whole PowerPoint, sustainability is not only related to environmental issues, and others use it synonymously with corporate social responsibility. Sustainability requires the consideration of time. The main questions are how firms balance their resource and investment over time, how to make intergenerational trade-offs. And with industry's leaders trying to buck the trend to short-termism, it is about time that strategy more fully integrated sustainability. Question 1. As we mentioned in the part of sustainability is not a responsibility. Business sustainability and corporate social responsibility have some similarities, so people always misunderstand these two concepts. However, these two concepts have different emphases. For sustainability, it focuses on intertemporal trade-off, and for corporate social responsibility, it focuses on current stakeholders' interest. Please review the part of sustainability is not a responsibility, and brief describes your understanding to sustainability and responsibility and give some examples of sustainability and responsibility. Question 2. Even though Amazon operates in an industry that shifts quickly, his founder, Jeff Bezos, his annual letter to shareholders advises them to think long-term. He says that if everything you do needs to work on a 3-year time horizon, then you are competing against a lot of people. Just by lengthening the time horizon, you can engage in endeavors that you could never otherwise pursue. Nowadays, many industry leaders try to buck the trend to short-termism, and it is about time that strategy more fully integrated sustainability. The question is, what type of methods can be used for business to mainstream the sustainability in their strategy?